Hey, how's everyone doing? Hello. Welcome to our stock trades. Hello. Yep. All right, let's kick it off. All right, ladies and gentlemen, how's everyone doing today? Welcome to our stock trades. Boy, do I got some exciting news for all of you guys. I was doing some due diligence, got back to the basics here, and we're going to do some really good research here, okay? So let's go ahead and get it done. All right, let's go ahead and... All right, so why are small caps set to explode? Okay, so hello. Welcome. Definitely share this video. This is an important one here, so let's get started. So first things first, for one of the most rarest times in American history, literally in 50 years, the U.S. banks are pulling back on business lending. This is a rising concern for banks and small cap companies. Historically, there have been negative lending precedes a solid returns for those sectors and the broader market. So essentially, historically, periods of negative lending, which is what we're experiencing now, precedes solid returns and growths. The way I like to capture this type of material right here is that the companies that end up surviving during this negative lending era are the companies that end up basically doing well in all the capital. Essentially, whoever rises out of the ashes of what has happened here in the small caps, which you obviously can see, small caps have definitely not dominated if you look at the returns versus the NASDAQ. But in this video, we're going to give you otherwise. I've been telling you guys about small caps, and now we have some data to back up our statements. So overall, what this is referencing here is the commercial and industry loans for the banks. Obviously, during the pandemic, there was an increased loans to it being backed up by the money supply from the Federal Reserve. And then we had a depression, and then things started to do really well. Then all of a sudden, now we're starting to stagnate. So let's go ahead and look at all the times where the commercial and industry loans, C&I, went from essentially 10% growth to negative or 0% growth. And as you can see, every time we get to this position, there's a high probability that this gray line here, gray highlights, is equal to a United States U.S. recession. So, we were getting really excited here regarding, could this be potentially a soft landing? And now we're getting into this conundrum where many people believe that the initial analysis of a recession is back on the table. And a lot of banks now are starting to act like, things are cherry rosy, and they're not really giving you the full picture. And I believe in the background of banks, they are essentially Wall Street. They're starting to realize the music may stop. And they're starting to recapitulate and reformat themselves to be able to sustain a recession. Many Americans are feeling this. Even I've spoke to some of my friends from high school. Again, these folks did not graduate into a 4-year education. They just stayed in high school and got their education from there. And they even know themselves that, we are slowly, the recession just makes sense. Folks that are in different areas in the country are starting to realize that Chick-fil-A is starting to have empty lines. Again, I don't like to basically use these anecdotal dates and evidence, but perhaps I like to look at the return and revenue growth of Chick-fil-A and all the service-based economies to see if there is some form of a trend. And to do that, you just look at publicly traded companies because they're the most easiest. So hold on, though. If we were to analyze every time we went from a 10% growth to being flat, if you were to analyze all these dips and all these drops, just taking the dip and the rise, the dip and the rise, the dip and the rise, and the dip and the rise, and also the dip and the rise, and last but not least, the dip. And who knows? Do you think we're going to rise? Well, no shit. But let's go ahead and do the analysis. So if you go to 1975, 1990, 2001, 2009, and 2021, and now we just got a signal from the C&I loans year-over-year growth cycle oscillating from greater than 10% to to less than 0%. Again, if you don't know what I'm trying to tell you here is basically when this line is above the green line, then it went from above the green line to below the black line. Essentially, when did these happen? Well, guess what? We just got the signal on October the 4th, right? So if we analyze these, you can start to see they're kind of near areas where following 2 to 3 years after the S&P 500 rises. So if we were to look at the median analysis here and the percent, in terms of the probability of the percent gain, we are getting to anywhere between 6 to 9 months to the future. We are getting an 80% probability that stocks are going to be rising in the 13 to like 20% plus, and that's for S&P 500 again, which is more larger companies. Now, if we switch it to total financial returns, we can see the dates here, and we see that more towards the 3-year range, we are seeing a 39.3%, essentially a 40% return. And again, this is the S&P 500, in terms of the financial total return. So if we were to essentially take 2023 and add 3 years to it, that's 2026. But 2023 is almost over, so let's add 3 years to that. So 2026 and 2027, which is why Chamath Palihapitiya said he was 1 year off. He was expecting 2025 and 2026 to be great. Now it's been shifted between 2026 and 2027. And you can blame that shift with Ukraine and Israel's, Gaza and Russia's issues that are happening in the Middle Eastern conflict. You can just blame, the terrorist organizations and yada, 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 all these issues happening that, we're not going to delve into the politics. If you want that, we could create it. But again, we're more of a stock market channel. So we want to focus on the business here, right? You can get that somewhere else. But we can give you guys my knowledge a little bit, but I digress. So overall, let's go ahead and analyze the Dow, the NASDAQ, the Russell, the 10-year Treasury, the US dollar, the gold, and the Bloomberg Commodity Index. And let's essentially stack all this data from a 1 month, 3 month, 6 month, 9 month, 1 year, 2 year, 3 year perspective when the CNI loan growth cycled from greater than 10% to less than 0%, or AKA from above the green line to below the black line. Okay, very simple. All right, this is not rocket science. So what do you see here? What do I care about? I care about the Russell 2000. Why? Because a lot of my investments now, I'm taking a bet. I have a bet, and I'm like, I believe that small caps are going to rise. There's a lot of risks in small caps, specifically Clover Health, but I believe that with the 10,000 Americans turning 65 and over every day, that should be enough tailwinds to allow a company to become profitable. Okay. So if we look at that from a 6 month to 9 month perspective, we should start to see the Russell 2000 grow. Okay. Now, just to take a side deviation note really quickly, we can go ahead and go to Yahoo Finance and then go to the Russell here really quickly. Go to the Russell and go to Yahoo Finance again. And then we can go to the NASDAQ. Actually, let's go to the S&P 500 and we can go to 5 years. So you can see how, we had our peak, and then post-COVID, we had our dip, and then we got a little peak. But if you look at the S&P 5, if you look at the Russell, you can see that we really haven't got that double bounce yet. We really haven't had that. The Russell has been stagnant. The Russell 2000 really hasn't seen much gains, which makes sense because the cost of borrowing money has increased and it affects more smaller companies that lack the sufficient cash flow. Let's continue. So if we were to stack in now, go deeper and look at all the sectors, these are all the sectors that are going to be doing well. Now, let me take a quick tangent. One of our beloved Mastering Stock Market students specifically said this is being affected by rates, but way too harshly. Almost all REITs trade above book value. Like, this is crazy for real, right? And I told him, yes. Why? If we go ahead and look at the CNI loan growth from greater than 10% to less than 0%, and if you look at REITs, what do you see? you see a 98% rate of return. Are you kidding me? Nearly 100% return for REITs? Yes, sirree. In the next 3 years. Exactly, because Irish understands the fundamentals. Irish understands book value. My mastering stock market members here, they know what the hell they're talking about. They are doing research. Okay. All right. But here's the thing though. We're here talking about small caps. You can look at all the other ones here too, discussion areas and whatnot. But let's look at small caps. Small caps are set to increase by 89%. This is the average small caps, right? All small caps. Some are going to rise more than others, especially if you calculate the intrinsic values, which we've basically done, and we've been beating this, to a stick, right? We've been beating this. But overall, this is what I'm looking at, ladies and gentlemen. I believe in the next 2 to 3 years, we're going to see a huge bounce in small caps. Again, we don't have to wait to 2 to 3 years to see the proof of concept. It's all about proof of concept. You can say, Al, you're full of garbage. Well, guess what? 9 months to a year, we should see some form of proof of concept. Okay. I doubt that we're going to see prices in the 90-cent range for Clover anytime soon in the next 9 months to a year. Also, whoops, who's this guy? Alien guy named Al Stocks. That's weird. Okay. Do you see a big crash before the recovery? Potentially, based off of what things are happening, potentially. Exactly. So it could be, but again, no one really knows. That's the thing. It's the and that's the hard part. But just a very quick tangent. We have our biggest Black Friday sale. We just activated it. $1,000 off. Yes, you get essentially $1,000 off. Okay, we want to make this very public because there's a lot of people that have been wanting the Mastering Stock Market course. So use coupon code Black Friday. If you use coupon code Black Friday, you can go here, type Black Friday in, and you go in, and then you go ahead and you see minus $1,000. You get $1,000 off the Mastering End bundle. You get essentially 50% off. And then you can use your PayPal, which is the interest free, or Affirm, where you can get anywhere between 12 to 18 months of financing. Okay, so this is one of our biggest sales. It's going to expire. We have a set limit of how many people can use it, given the big deal. This is lifetime access to all of our stock market data, our research, and beyond. Again, coupon code Black Friday. Can't wait to see more of you guys. Okay, so let's go ahead and let's what I was going to do. Oh, yes. So now let's go ahead and zoom out really quickly. And let's go up here and let's go to smart money. And we will explain smart money really quickly. But let's look at the comment section. I'm your biggest fan. Hey, man, I appreciate it. Hell yeah. You are over my budget by 50 cents. Oh, that's so hilarious. We do offer, it's all profit proceeds are donated to charity. We do offer a book, of $14.99, The Intelligent Investor for the Modern Reader. So, we do offer some aspects to at least push you forward. And yes, brilliant. That is a huge freaking discount. I wasn't kidding. That $1,000 off, $1,000 off. And you can refinance, for 0% interest for 6 months, based off of your credit eligibility. But again, this is a really, really, god dang good deal. Okay, so let's go ahead and look at smart money, dumb money confidence right now. As you can see, as stocks start dwindling down, dumb money confidence has gone down. Again, what is smart money and dumb money for people that haven't seen this before? Okay, well, what it is when you go to your brokerage, especially, Robinhood and whatnot, it's free. But again, how do they make money off of you? Well, there's payment to order flow. And there's also another criterion that they use. They essentially take all of your information, take out your name, take out your social, and then put you on a graph. If you make under 100 million, which is majority of retail investors using Robinhood, they take that data and they basically look at and they sell it to hedge funds. I get this data directly from a former hedge fund where it parcelates smart money, people that make over 100 million and have over $100 million portfolio versus dumb money. And as you can see right now, as stocks fall, smart money is starting to essentially double down versus dumb money being off. Again, as stocks were rising, this was not a great time to buy. Again, if it's intrinsic value, then it's another purpose. Again, nothing's black and white, but overall, smart money was out of things while dumb money was going in. Stocks basically stopped faltering and dropping. Dumb money basically starts selling. Smart money comes in and takes the lead. Okay, now let's go ahead and look at hedge fund exposure. Now, when hedge fund exposure are at the top part of the bracket, historically, indexes outperform individualized stocks. Now we're in an era where it's looking pretty lucrative. As you can see, when stocks are nearing their bottom, as you can see in 2020, September 2022, and October, where we had that bottom when many predicted, we start to see we're in that range. Guess what? We're in that range again, indicating it's possibly a great time to go in. As you can see here, if you go to Tesla really quickly, you can see Tesla as $197. Again, there's obviously a reason for it with a bad quarterly earnings report, but overall, you can start to see that stocks are starting to drop. The question is, when is it, going to happen? What's the bottom, and what's the Fibonacci sequence retracements? Then you can use our stock terminal to map out the Fibonacci retracements. Then you can use technical analysis to help with your fundamentals, et cetera, et cetera. Again, everything is backed up by data. Now, last but not least, we can look at the equity. Two more things: equity hedging index. Again, when things start to peak on the equity hedging index, it's a great time to basically double down. Every time there's a period of rising, we don't really want to buy in the red. We want to buy when it's near the green, and it's definitely a great time to look into consider this part of the argument. Then you can look at Robo, which is your retail puts and calls, and basically you can see that every time retail investors are buying puts, they're bearish. And every time retail investors are bearish, you want to do the opposite of retail investors, because retail investors are dumb money. And if you want to be like a retail investor, you're going to be broke your whole life, which is why they got a lot of puts when the COVID crash happened, which technically this was a great time to buy. And they bought a lot of calls when it was a great time to sell. And guess what they're doing now? They're buying a lot of puts while it's a great time to buy. So that's essentially the analysis there. If you really enjoy this video, please consider doing, liking the video, certainly sharing it and subscribing. And again, a shout out to our $1,000 off Black Friday sale. Use the coupon code Black Friday and get $1,000 off our mastering and or bundle courses. And you can supplement it with PayPal or Affirm for a buy now, pay later, and be able to spread it off between 12 to 18 months. I really appreciate your time and consideration. Oh yes, I'm definitely, in my humblest opinion, from an educational perspective, I definitely am bullish on Clover. As you can see here, small caps are set to explode 89% in the next 3 years, and I believe the fundamentals are going to be improving, and everything is basically falling in line like a sniper and Navy SEAL taking a hit off three football fields away. When everything aligns, the wind is aligning, the fundamentals are aligning, the air quality is aligning, the visuals are aligning, and the hit is basically about to do really good. Okay. Hey man, I really appreciate your kind words. Brilliant. It's honored to be able to help you guys. And again, a lot of this research, unfortunately, is not provided to retail investors. Like if you go to Robinhood right now, or if you go to Webull, or let's say, for example, if you go to Yahoo Finance, this is the garbage they give you. They give you just national debt is finally a real world problem. They give you, stuff that, is already priced in the market, right? We know that the fiscal 2023 year has to basically be refinanced at a higher interest rates, meaning that the Federal Reserve is going to have to start cutting soon, because, we have $33 trillion. With the new current interest rates, we're going to have to pay approximately anywhere between $2 to $3 trillion off of that, when we only collect around $4 to $5 trillion in our taxes. So they give you information that is just bullshit. That's not really going to help you. This is real research stacked on, really organized, and I'm very happy to be able to provide this for you guys. Okay. And yeah, that's all I have for you guys. Again, coupon code Black Friday. Very excited to bring this deal, and very excited to basically double down on our platform. And many great things are coming. I can promise you and assure you that. Yeah, that's all I have for you guys. See you on the next one.